The Great Investor Migration. In the last few years, a great migration of money has begun. Investors have pulled trillions of dollars out of traditional mutual funds and poured them into ETFs. This isn't just a trend, it's a revolution. But why is it happening? And are you on the right side of this change? The debate is fierce: index funds versus mutual funds versus ETFs. It's a battle over cost, taxes, and control of your money. The answer started with an idea so simple. Wall Street once called it un-American, but it's now changing how millions invest. In this video, we're cutting through the jargon. We'll give you the definitive 2025 guide to what these funds are, how they really differ, and a simple blueprint to decide where your smart money should be going. Cracking the code: what these funds actually are. The biggest mistake is thinking this is a three-way fight. It's not. It's about understanding two things: the strategy and the structure. First, the strategy. Active management is a fund manager handpicking stocks, trying to beat the market. It's custom, and it costs more. Passive management is simply tracking an index, like the S&P 500. It automatically buys what's in the index, no guesswork involved. It's simple and cheap. Second, the structure, how you buy it. A mutual fund is like ordering from a restaurant. You place your order anytime, but it only gets processed once at the end of the day at a set price. An ETF, or exchange-traded fund, is like a food truck on the stock exchange. You can buy or sell it anytime the market is open, and its price changes constantly, just like a stock. Here's the key: an index fund is a passive strategy. You can get it in either a mutual fund structure or an ETF structure. The confusion ends when you realize index fund is what you're buying, while mutual fund and ETF are how you're buying it. The 2025 showdown: 6 factors that matter. Okay, now that we know what they are, let's put them head-to-head on the 6 factors that will make or break your returns. Factor 1: cost, the number one predictor of success. If you remember only one thing, make it this: cost is the single most reliable predictor of your future investment success. This was John Bogle's core insight. Actively managed mutual funds have the highest costs, averaging around 0.65%. Passively managed index mutual funds are much cheaper, around 0.05%. And many broad market index ETFs are even cheaper, some below 0.03%. On a $10,000 investment, that difference between 0.65% and 0.05% might not sound like much, but over 30 years, that small fee difference can cost you tens of thousands of dollars in lost returns. It's a massive, silent drag on your wealth. The winner on cost is clear: index ETFs. Factor 2: tax efficiency, what you keep matters. This one is huge, especially if you're investing outside of a retirement account like a 401k. Here's the problem with the mutual fund structure. When investors sell, the manager often has to sell stocks to raise cash. If those stocks have gone up, it creates a taxable capital gain. And here's the crazy part: that tax bill gets passed on to all shareholders, even if you didn't sell a single share. ETFs have a secret weapon that avoids this. It's a mechanism that allows them to swap shares with large institutions without selling the underlying stocks and triggering those taxes. This makes ETFs vastly more tax efficient. The winner on tax efficiency, by a landslide: ETFs. Factor 3: trading and liquidity, flexibility versus discipline. As we covered, ETFs trade all day long like a stock. Their prices fluctuate constantly, giving you incredible flexibility to buy or sell instantly. Mutual funds only trade once per day at the closing price. You put your order in, and you get whatever the price is at 4 p.m. Eastern Time. For active traders, the ETF's flexibility is a massive advantage. But for the average long-term investor, the mutual fund's limitation can actually be a hidden benefit. It enforces discipline and prevents you from panic selling during a midday dip, which research shows almost always hurts returns. This one is a tie. The winner is ETFs for traders, and mutual funds for disciplined investors. Factor 4, accessibility and automation. How much do you need to start? Mutual funds often require minimums of $500, $3,000, or more. With ETFs, the minimum is just the price of one share. And thanks to fractional shares, you can now buy a slice of an expensive ETF for as little as $1. On the other hand, if you want to set it and forget it with automatic investments, mutual funds have traditionally been king. It's incredibly simple to set up automatic transfers. While many brokers now offer this for ETFs, the system for mutual funds, especially in 401(k)s, is still the most seamless. Winner on accessibility, ETFs. Winner on easy automation, mutual funds. Factor 5, transparency, knowing what you own. Want to know what's in your investment? With most ETFs, you can. They are required to disclose their full list of holdings every single day. Traditional mutual funds are more opaque, typically only reporting their holdings quarterly, with a lag. You might not know if your fund has made a huge bet on a risky stock. The winner for transparency, ETFs. Factor 6, the final scorecard. So let's put it all together. When you look at the factors that have the biggest impact on your long-term wealth, cost and taxes, the ETF structure is the clear champion for most people investing in a taxable account. The new battlegrounds, active ETFs, crypto and other traps. But the ETF world isn't all simple and safe anymore. This is what other videos miss. First, active ETFs are exploding. They promise a pro manager with the better ETF structure. But remember, most active managers still fail to beat a simple index fund over time. Second, thematic ETFs, funds for AI, robotics, or clean energy. They tell a great story, but they're often less diversified, have higher fees, and launch at the peak of a hype cycle. Third, leveraged and inverse ETFs. These are for pros only. They use derivatives to multiply the daily return of an index. Hold them longer than a day, and compounding can destroy your returns in unpredictable ways. Finally, crypto ETFs. Spot Bitcoin and Ether ETFs are here, making crypto easy to buy. But convenience doesn't change the asset's fundamental risk. The lesson: the ETF label is no longer a guarantee of a simple, diversified investment. You have to look under the hood. The psychology of investing, your own worst enemy. If the data is so clear, why do we make the wrong choice? Because of our own brains. We are wired with biases that make us our own worst financial enemies. We have overconfidence bias, thinking we can outsmart the market, but studies show the more we trade, the worse we do. We have action bias and FOMO. Passive investing feels boring, so we chase hot trends, usually right at the peak. This is why the Boglehead philosophy is so powerful. It's not just an investment strategy, it's a behavioral one. It's a system designed to protect you from your worst instincts by accepting that the average market return is an exceptional result once you avoid fees and emotional mistakes. It's about staying the course and tuning out the noise. Your personal blueprint. Which fund is right for you? Okay, let's build your personal blueprint. It comes down to two questions. Question 1. Where are you investing? In a taxable brokerage account? Go with index ETFs. Their tax efficiency is a massive advantage here. In a retirement account like a 401(k) or IRA? Taxes don't matter inside the account, so both index mutual funds and index ETFs are great options. This brings us to Question 2. How do you plan to invest? For regular, automated investments, like from a paycheck, index mutual funds are often the most seamless choice, especially in a 401(k). For lump sums or if you want maximum trading control, index ETFs give you that flexibility. For most people, the simple, buy and hold Boglehead path using broad market, low-cost index funds is the smartest way to build long-term wealth. The future is simple. Key takeaways. So, this great investor migration isn't about good versus bad funds. It's a shift towards what John Bogle preached 50 years ago: simplicity, low costs, and tax efficiency. The ETF is just a more modern technology for that timeless promise. Here are the 3 keys for 2025. Structure over strategy. For most people, the ETF structure is superior, especially in taxable accounts. Cost is king. The lower the fee, the more of your money you get to keep. It's that simple. Look under the hood. The ETF label isn't a magic word anymore. Beware of complex, risky products. Building wealth isn't about chasing complexity. It's about choosing a simple, proven path and staying the course. Now you have the blueprint. If this video cut through the noise for you, hit that subscribe button and the notification bell. We release new videos every week to help you make sense of the money world. And now I want to hear from you. Let me know in the comments, are you Team ETF or Team Mutual Fund, and why? Let's discuss. Thanks for watching.